Cool, great. Welcome back. So this is a part two. So let's carry on. Interest income. I've already talked a lot about interest income. Key point: critical. Compared to the individual, sole traders, income is interest income is based on receipt. That's the individual, and the sole trader. That's receipt. On receipt, when you get it, you record it. We've even seen questions, haven't we, with the individual where rental income as well as property income is receipt as well, not accrued. It's with the company because we expect to be applying, if you like, your classic accounting standards, right, and concepts at least somewhere. And really the reason is, you can imagine why the individuals will get all of these exemptions, so to speak, from the normal accounting principles. It's just because they're not big enough and it's just a bit tedious. But with the company, we expect to see things at the accrual basis, so you must apply accrual accounting. So typically, back to your double entry of trying to find out what the accrued income should be, is really the question here, not what is paid per se, but what it should be, right, for that year. And then, of course, like I say, classification is very important. This issue of classifying clearly between trading and non-trading interest income. So just kind of highlighting this, going through this table very quickly, and picking up what they're doing over here. My pen just fell. Sorry. Yeah. So what we have here is. So again, like I think I highlighted this earlier on, where I mentioned that. When we're dealing with trading income, the question here is, in any interest relating, I'll come back to this point. This is really the key point here, right? You expect that if you've taken out anything, any interest that you're paying on any loan to deal with your day-to-day running of your business is fine and allowable, right? You can write off your trade receivables as well. So that's fine. That's fine. You would almost expect, right, that to be the case. Trade related. Now, of course, we don't expect a business that's trading in fish to have any real trading interest income, apart from maybe interest coming in on their bank account, because they're not a bank. So, and we will not be seeing this in the exam. So it's very unlikely you'll ever be including trading income and interest income as part of your trading, your trading income. Rare. Now, of course, non-trading, yes, we can have your bank interest, you can have interest from investment income, maybe interest from bonds, something along those lines. The key point here is it's not to do with trade. And then, again, you might have taken out a loan, and these are particularly the ones they like to ask, to buy shares in another company or investments as well. For the company, interest paid on overdue corporation tax is an allowable expense as well. So buying a loan to buy an investment property or buy to let, whatever you want to call it, all under non-trading. So it's just about classification, nothing special. Okay, great. And you can see here, this is included within trading profits, and this is included within interest income. Sometimes you might wonder why all this, but you'll see later on that there are certain, the thing about the advantage here, the issue here with trading, the government really want to try and focus on, the benefits are really for those who are actually trading. And sometimes any losses from here, if you like, can be used in different ways. You can go back, if you like, and use them, but you're restricted when it comes to things like property income and property losses. You can't really, they can't really benefit from this usage. So it's really important to restrict trading from non-trading, as we will see. Right, okay. And also it's to make sure people aren't putting through expenses that aren't really to do with trade, if you like, as we saw with QCDs and things like that. So it's an attempt to try and restrict trading losses. Cool, great. So and this really kind of follows the point. It's really like look at what's causing the loan, and that will help you decide under whether it's trading or not. If the loan is relating to dealing with trading, then it is trading. If it's not, then it isn't. Right, so I'm not going to do the whole question. I'm just going to highlight the point here. Here we have bank interest payable on loan to purchase machinery. So this is trading. Interest to shares, no, this is not trading. Interest payable on loan to purchase investment property, not trading. Bank interest receivable, not trading. Fair enough, it is to do with your bank account, but it is not trading. So yes, you have this amount here. So all you have to literally do is, what are we saying? This is the net profit. All this has gone. So in here, in this figure, you have this interest received has come in, and you've deducted these three. So you need to add these two back, add this back, and deduct this, right? Because this includes this as income. No, it does. It shouldn't. Take this out and add these guys back, and do that, and just check the answers quickly. And that's all we're literally doing. Property income, like I mentioned earlier on, you saw when we saw the initial slide that property income is taxed at corporation tax. A company can have some UK property, nothing wrong with that. Like I've highlighted, everything is very much on the accrual basis. Of course, remember when we talked about leases, the little thing there about 51 minus n over 50 times the premium gave us the income element. Yes, you can please review that again. Now the whole thing, I mean, this is property income, the whole thing is taxed, right? Remember, unlike the person who's actually taking out the lease, where they can then split that lease over the life of the lease, but you can't do that if you're a company, the recipient, property or company or individual. So what are we doing here? So that's the rent accrued for the period, any allowable deductions as you would expect, and the lease premium as for individuals, right? And we don't have all the same. We don't have all the drama, that whole 50% restriction with the individual as we do here, as we have in the individual. Remember with the interest income, it's if you like. So interest on loan to buy rental property, interest payable on loan. Interest payable on loan to acquire. I mean, it is not allowed as a property income expense. Remember, we put this through. We've just highlighted. We've just literally talked about that. This goes under interest income. Yes, if you like. Then this is what I just said. Relief is given under this, so that interest goes under here. But like I said, there's no restriction. There's no, because it's technically trading as a company to enjoy that benefit. So you might remember. So this is one of the reasons why a lot of people were trying to form. Well, many people now will form companies when they're dealing with property now, as opposed to once upon a time where you did it as an individual and you had those restrictions and also higher taxes as well. Okay, great. So property losses. So you might have a loss in your year in terms of you might have made some property losses, and that's not a problem. HMRC allow you to offset those losses against, I mean, automatically offset those losses against total profits before QCDs. We'll see that what HMRC will allow is you to actually use these. I'm just saying it now just because imagine you had, like I said earlier on, you can't carry back property losses. That's the first problem, but because we're not in dealing with losses just yet, we just take the simple initial view that you have some property loss. So maybe this is you have some trading income, chargeable gains, property losses. So again, you can use these losses against these incomes. Of course you can in your year, and that will reduce your overall total income, taxable total profits. Yes, and then carry forward the rest. But you must use it, of course, before your QCDs. Like I say, QCDs are the last sort of allowed things that you can use. So, and you can carry forward and use it against total profits before QCDs. So again, what you do have is the opportunity to, and we'll see that when we come to look at the use of losses, we can restrict losses to protect QCDs as we go forward. It's just in our year that we can't. But I almost feel like I'm talking about losses already. I want to be careful. But that's the general principle. So you can use these losses. The key point again when we come to losses is we cannot take property losses backwards. Okay, great. So so yeah, I mean, look at this example again. Just be careful. Well, all I'll say every time is, like all things, what you want to make sure you're careful of, which is classic in Section 8 questions, is this idea of dealing with the dates. Be careful. So because it says the 1st of June, 2018, you want to make sure that it's accrued. So you want, and this is to the 31st of December. So you want to make sure you're only dealing here with, what is that? That's 7 months of annual rental income, and then work out the lease. Initial premium of 45,000 is a 10-year lease. So you have 51 minus 10 over 50 times 45,000, right? That's the lease amount. That's the lease income, or the income element, or the income element of the premium that we must recognize straight away. The rest is capital, but we must recognize this straight away. Yeah, and so that's example 4. And so let's move on. Let's carry on. Yeah, and I mean, as you can imagine, okay, yes, a business receives dividends, but the reason you're receiving dividends is you remember the dividends are paid out after tax has already been paid. So company A sends you some dividends, you getting those dividends, your company B, tax has already been paid on that, so it's unfair to pay tax again. So that's excluded. We don't tax those again. QCDs, like I've said. So again, what we even can allow for QCDs is what's been actually paid. Right, it's what's been actually paid, and hopefully, as we see examples, we'll see what's going on. You pay them gross. It's not what we hope to pay, but what is actually paid, as you can imagine. That's that. And then let's move on. Yes, and so now the next bit here, which is again, like I think for us, what you guys will have, which is great from now on, is that I mean we're using Finance Act 18. So when I talk about acts, I almost didn't really mention this. It's really the 1st of April, isn't it, to the 31st of March. So you typically look at the year it starts in. So for example, these are the the rules we're using, Finance Act 18, and it's basically based on the start of the tax year. So we have, yeah, and this is the Finance Act 18 is based on the 1st of April 2008 to the 1st of March 2019. And it is at 19%. So what's beautiful is that you have exactly the same thing. It's exactly the same thing for the previous year at 19%. So we're never going to have, the problem always is the overlap. So we must apply the rules based on the year. So if any accounting year ends overlap, then you might have issues. We don't, because this is 19 and this is 19. And I believe it's going down. But prior to this, it was 20%. So you can imagine, you can see in this example, if you had a year end of the 31st of December 2017, you can see that here you would have had here 1st of January 2017 to the 31st of December 2017, and the Finance Act would covers the 1st of April 16 to the 5th of April 17 at 20%. So there's 3 months in your year in this Finance Act 16, and that's at 20%. So you'd have done 3 months at 20% and then 9 months at 90%. So that's the other thing. Again, because we're now in, I mean, it's rare. If it is, just be very careful. But otherwise, you now know that all corporation tax, the company's tax on total profits will all get this 19% charge. So I play around with that. I mean, the key point here is watch out. We don't allow dividends. Oh, I'm almost at 15 minutes. We do not allow dividends. That we ignore those. So add those two together. It's all there. Multiply that at 19%, and you're there for your corp tax. So play around with that. Look at the answers, and you're there. And the same thing literally for this. So here they want you to break it up because they're giving you the 30th of June to force you to just have a go if you like. So here we have the 1st of July 16 all the way to the 30th of June 2017, and so it's just watching out for what happened at the 31st of March 2017, if you like. So here what March, April, May, June. So you have 3 months here at 19%, and you have 9 months at 20% when you split this up. And just watch out again, like I say, it's nothing untowards. It's just treating it that way. here where we are. So ignore this. It says this is accrued. You're not interested in the accrued. You're interested in the actual QCD that was paid. We're not interested in dividend income because we don't charge that again. So you have that. You're allowed this. You're allowed this. I mean, your calculations are composed of the trading profits. Your calculations are all composed of the bank interest income, 46,900, I believe that is, and we are deducting 20,000 of QCDs to get our answer. And of course, split that 9 month way. Split that 9 months at 20% and the other 3 months at 19%, and you're there. And you're there. Oh, good. I'm past 15 minutes. Okay, great. So yes, I'll pause there, and we will carry on in the final part of this video.